I'm a long-term shareholder of Alibaba, and once again, this stock has gone down. So after months of not buying any Alibaba shares and actually selling, I added more to my portfolio. Revenue is growing once again at 8%. Although it is still fairly slow for the historic Alibaba performance, it is a re-acceleration of the slow-moving business, while they have divested some parts. First of all, their cash machine, Taobao, Tmall, all that stuff. While direct sales have plummeted 9%, customer management, the high-margin segment of this business, is up 9%. Plus, they are now increasing their take rate here slowly. They have one of the lowest take rates in all of China now, after years of heavy competition, and they now are slowly increasing it again. And here is also where they use their heavy cloud position. For a company like Alibaba, what is important? How can they use this AI? How can they use it to improve their shopping algorithms, their services to merchants? Because if they offer a service to merchant where they can use AI to boost sales by 10% by improving placement, improving wording, people are willing to pay for that. And here Alibaba is coming out as a winner. Alibaba is one of the leading companies in AI now. From first beating with their newest models some time ago, now making different models, experimenting. For example, now they're releasing one for cancer detection. Now, of course, this is not important, but it shows you how far ahead Alibaba is now in AI. But at the same time, they're not ignorant when it comes to spending. The CEO warned AI industry is showing signs of a bubble. There was too much investment going on. Microsoft scaled back investment. Amazon is also now slowly starting to scale back investment when it comes to building new data centers. So they're not throwing money hand over fist on the problem. They're being conservative here. So while the cloud segment in itself is growing currently 13%, AI-related products are growing triple-digit year over year. Now, of course, they started off very slow, but that just shows you Alibaba is a leader in AI in China. So in itself, the growing cloud segment is great, but the AI helps them double. They're improving their marketplaces with it, while also offering products to the public. That is also, of course, playing into the international e-commerce. But here they had to cut their own margins, because they're heavily competing with Temu at the moment. So while they're growing fast, it is with low margins. Now, of course, this is going to be more volatile with the Trump tariffs. But overall, I think Alibaba can succeed internationally. They have the capital behind it, they have the logistics. Kind now, it is still just the logistics side of the business. It is great that they have it because they need the in-house logistics. This is what makes e-commerce companies strong. If they don't have their own logistics, they're easily replaceable. So I don't look to profitability here much. I just wanted to work together with the e-commerce business. Now, local service, however, there's a lot of potential here. They are competing here with Meituan. And what is most important here? How local it is. You have your infrastructure set up there. You can offer same-day delivery, which is now becoming the new standard in China. So you need to be heavy there as well. And here Alibaba has Ili.me. And if they can combine that with the e-commerce segment, that they can easily offer same-day deliveries in higher tier cities and slowly expanding to more rural ones, then that is once again something which puts them above JD. When it comes to AI, Alibaba is going to crush them when it comes to optimization. Now, of course, AI is not everything, but if you can improve, for example, the searching algorithm there, improve the deals customers are getting specific to the individual, that is a huge advantage. Now, of course, in exchange, way cheaper than Alibaba. Our other segment is the segment I just don't like. Here was also stuff like Sun Art, and this is all being sold off. I like that this is not a huge focus of the business. The new CEO is slowly cleaning that out. Now overall we can see Alibaba is improving their business, growing faster, establishing key footholdings. Now while net cash is up, free cash flow is down because they increase their investments. They're investing in the cloud, and I like that. They're not spending too much, but they're spending enough to become a big player in AI, in cloud, to be well positioned there. This is something they will need to compete against Meituan, JD, and also internationally against Pinduoduo. So I don't really see this as too huge. The CEO is grounded. He knows to not just throw everything at AI. Meanwhile, you still have a huge net cash position. Of course, it shrank a bit because they did the huge amount of buybacks, but you still have 51 billion. Still 1/5 of the company. And share buybacks are kind of slowing down. Why? The stock became more expensive. When the stock was really cheap, they threw in cash. In March 2024, they bought back 65 million shares, afterwards 75 million. But now, slowly, after the rise in the shares, they didn't buy back as many. Here, they didn't buy back any shares really. When it came back down, they bought back shares again. Now it came back up, they didn't really buy back shares. And now they're back to buying back 20 million in shares each day. Do I think they could have bought back more when it was way cheaper? Yes, but I like how management approaches it. And this is what I like in Alibaba. It is not a reckless company. It does strategic investments now. The new CEO cleaning up the business, focusing investments on where they're needed, and allocating capital very conservatively. Operating cash flow has not really recovered yet because they were so long focused now on going back to growth. Once that's coming down, they're increasing their take rate, especially with operating income already being up huge. I think they're gonna go above 200 billion yuan. Let's go with 200 billion yuan. It's 27.5 billion in free cash flow. That would be above 11 in free cash flow per share, but to be even more conservative, let's go with 10. What are our growth assumptions? Revenue is currently at around 8% growth, plus some margin improvement is gonna happen soon. Even if we don't assume an acceleration in growth, we stay at 8%, 1% margin improvement, and only 3% in buybacks, because they're currently lower, but because of that we're accumulating cash again. After 5 years, we're gonna have improved their positions in cloud and their AI models. So I think we're gonna crush some local competition there. I think especially JD is gonna lose. It's gonna accelerate a bit. 15 multiple. 20% of free cash flow paid out via dividends. Now they're not doing that as much right now, but I think they will soon increase that, especially with the buyback slowing down. They have $21 in cash per share, 50 multiple. That is around $200. That together combined is $220 a share. So 86% upside. Now in my last video I had lower numbers, but I change my projections whenever the company fundamentally changes. I see that Alibaba is doing a lot of good investments right now into the cloud and also products which improve the e-commerce. Now what if it goes even better? Company re-accelerates revenue growth. That wasn't factored in before much. $288 a share. What are the downsides? Revenue goes back down. No acceleration. Margins stay at the same level. Only around 5% revenue growth plus buybacks. Little increase once the investments go down. 10 multiple, $95 a share, ignoring the cash on hand. So if you factor in the cash on hand, we would make still 10% return there. This is why I'm adding back to Alibaba. I like the risk reward here right now, and it is one of my biggest buys right now. What do you think? Write down below. Have a good day.